Okay, so chapter 9 deals with, by the way, you know, did I offer you guys encouragement and everything over the test when I give it back? That'd be the encouragement. Yeah, because, you know, don't forget, the only thing that matters is you get your degree. This won't stop you from getting your degree, right? Well, no, it's true, because that is the only thing that matters. And that is the only thing that matters. And then the worst that can happen to anybody is you've got to retake the course. That's far from the end of the world. I hope that won't happen. Well, of course, I'm sure, I hope that won't happen. I'm sure it won't happen. But you know, that just realistically speaking, that's the worst that can happen to you. So you know, so and I bet you'll do just fine in the course and just pass the course. Did I tell you when I was at my graduation? I told you, yeah, okay, all right. Anyway, and again, you just get your degree. Now, by the way, I felt kind of guilty about that deal about getting the C's, because what happens is you people have a lot of potential and you can go a long ways. So always keep your doors open, always get good grades and all that, because it's very likely that as soon as you finish that bachelor's, you'll say, I want to go on for a master's, MBA. WSU-SB has a master's in taxation. So keep that door open, because it's very likely. Well, I guarantee. Well, some of the people in this room will go on for a master's. Okay, let's face it. Okay, all right. So let's go ahead and get into chapter 9. Okay. So chapter 9, what we're talking about here is accounts receivable. Okay. So with accounts receivable. So we're talking about sales on credit. Okay. So in this case, we have a sale on credit. Okay. So we're talking about sale, we're talking about credit sales. Okay. All right. And so in this particular example, don't forget what we have here is there was a sale, a credit sale of $950. The cost of the goods was $800, and they collected the $720. So they didn't. So the customer paid you, but they didn't pay you for the full amount. So again, when you made the sale, it looked like this. On July 1st, you debit accounts receivable for $950. You credit sales for $950. You debit cost of goods sold, and I'm going to abbreviate cost of goods sold for the $800. You're going to credit inventory, and I'm just going to put inventory, but it may be merchandise inventory. It could be a longer title. I'll just put inventory. Okay, for the $800. So you're converting this asset into an expense. You're accounting for the revenue. And then, when they pay you, say they pay you on the 2nd, what you do is you debit cash for the money they send you, and you credit accounts receivable for the money they send you. Let's make this more realistic date. Now, what happens on this thing, and then of course don't forget you have the subsidiary ledger. Okay. So, now what about a credit card sale? Okay. Well, there's two ways you can do this. In many cases, you know, when you buy something in a credit card, they swipe it, and it comes. And what it is when they swipe it, it comes out of your account immediately. When that happens, it's considered a cash sale. So in this case, what the deal is? Was it?
Can you pull that down just a little bit?
Sure.
Right. Thank you.
Okay. All right. So in this case, it was a $100. So in this case, it was a $100 sale, and there was a 4% credit card. Okay. Charge. Okay. Now, in this case, so it was $100 sale, so if we have $100 times 4%, that comes out to be $4. $100 minus $4 is $96. So, let's say the sale was in July 15th. What you got here is cash will be debited for 96, because that's the cash you received. You have credit card expense. It will be debited for 4, and the sale will be credited for 100. So what you do in this thing is, what happens with this, as far as accounts receivable and credit cards and all that, if you, for a customer to shop at your store, they have to be able to buy the goods, right? So if they don't have the cash on them, this is the way they do it. So if you extend credit, what happens is you make more sales, you get more returns, there is some expense, but as a general rule, you're way ahead by extending credit, okay? Now the way most stores handle the credit is they accept credit cards. Now what this does is this transfers the liability to the credit card company. So in case when this customer came into your store and bought this $100 worth of stuff, and now the customer goes bankrupt, it's the credit card company that's out the money, not you. And of course, for that service, they charge you, okay? Now, a lot of times, this is a 4% fee, but a lot of times you can get these fees down if you do some calling around, and whoever handles this particular credit card, it could be a bank sort of thing, you give them a call and say, how much will you charge me to handle this credit card? And they'll say, 5%. You say, thank you. And then you call another bank and say, Bank A said they charged me 5%, can you beat it? And then you do some calling around and they say, well, we'll make it 3. So then you call Bank C and say, Bank B, you charge me 3%, can you beat it? And so a lot of times, if you call around, you can get these credit card charges down to like 1%, okay? And don't forget they vary by credit card, because American Express is often the most expensive to carry, to use. That's why some stores refuse to use it. Okay? So, to sum up, we're talking about credit sales. You'll make more sales if you do this. When people buy things on credit, they feel they'll buy it kind of like impulsively, but they're also more likely to return them. They just feel okay by returning them too. So you have more sales, more returns, which you're usually ahead by doing it. One way of handling that is with a credit card. Now, we mentioned there's 2 credit cards. So this is the one where we've all seen you go to the merchant, the merchant swipes your card in a cash register. That's considered a cash sale because the cash is transferred to their account instantaneously. Have you guys also gone to these places where what they do is they put it in that machine, they put your credit card in the machine, you put a slip on top of it, they write the data, right? Then what they do is they send those in. Well, when you have that sort of a situation, instead of having a credit sale, it's an accounts receivable. So in this case, what they did is, they're considered a cash sale when it's all electronically done. When they have the machine, it looks like this. So again, on July 15th, it's the same sale, but now accounts receivable is debited for the 96, right? And you have a credit card expense of 4, and you have a sale of 100, okay? Now what you do is you get all those slips and you send them in. And then on the 20th, they pay you for those slips. And so, I'll put number 2 here. So in this case, what you do is cash is debited for 96, and accounts receivable is credited for 96. So when you have, when they use that system where they they print it out in the slip, they send the slip in and they get reimbursed, then of course it's an accounts receivable. That make sense? Yeah.
So I have a question. So like on the top one, how you said it's done instantly. So I know like some credit cards when you buy it doesn't actually hit your like actual account for a couple days. Would that still count as the first one?
Yeah.
Because
don't
of the
forget, this is
electronic.
the merchant, right?
Okay.
So even if it doesn't show up on the customers for a couple days, what happens is, they swipe the card with some sort of electronic device, and the $96 is transferred to the merchant's account instantaneously. Then instantaneousness, that makes it a cash sale. Now, it can take a day or 2 to show up in your account,
Okay.
but that's just a different matter. And then again, in both cases, don't forget you record the expense when you incur it, which is at the time of the sale. Okay. All right. Now, so let's say, instead of having a credit card, let's say you carry your own accounts receivable. And in most cases, let me just go back here. So let's do this, before we move on. Let's do quick study, 9-1, and you find that on page 380. And let's just practice this. Okay, so let me go to page 380. And they have one of each. Okay, so let me put this up here on the board. So in this case, it's down here, and just put this here. So now, prepare the journal entries for the following credit card sales transactions. The company uses the perpetual inventory system. All right. So you sold $10,000 of merchandise that cost $7,500 of MasterCard credit sales. The net cash receipts from the sales are immediately deposited in the seller's bank account. MasterCard charges a 5% fee. Then in the second one, this is one where they have the little slip that they send in. Now they sold $3,000 of merchandise that cost $1,500 in an assortment of credit cards. Net cash receipts are received 7 days later, 4% fee charge. Okay? So you guys want to do that, and we'll see if there's any questions before we move on? By the way, is there anybody else who'd like to see their test? All right, sounds good. Michael, Courtney? Sure. Let me do this. All right, so listen, kindly don't take any notes and leave everything back. Okay, here you go. Here's how the class did. Here's your test. Here's the key. Okay? All right, Courtney, Michael, anybody else? Okay, sure. Alicia?
So there were 3 points added to this after.
Yeah. Yeah. And you guys kindly don't take any notes and make sure I need everything back. Alicia, can I hand you that? Okay. All right. So, here's the first one. Let me see if there's any questions. Are you guys doing good on that? And this is where they run it through the machine. The money's transferred here to the merchant's account instantaneously. Here you go. Thank you. You're welcome. All right. Courtney, you want? Sure. Courtney, when you see the, after the key is done, can you give it back to Michael, the guy in the green shirt? Okay. Does anybody need the roll? Okay, here, let's go through it. All right. Okay, you need the roll? Sure. And then you hand it to Ryan when you're done, and then there's Christopher. All right. And Christopher, you'll make sure that Eric gets it? All right. So here's what it looks like when they use the card and they send it in. Then it's an accounts receivable. Okay. First, when you're done, could you hand it back to Alicia?
Of course.
Alicia, when you're done, could you hand it according to the lady in the far
Sure.
end? Okay? And just a test. Is anyone here? Okay.
I wasn't here either.
Oh, okay. Here you go. And there's 3 points is added to that. And kindly don't take my notes and I need everything back.
Mhm.
Okay?
So we can find the error from the top of the
Sure. All right. Any questions on this? You guys doing good? Okay. Are you guys done with it? All right. So let's go ahead. Now, let's have credit sales. So what we got here now is if you extend credit, what happens with credit is you extend credit. If you do extend it, you'll probably make more sales, but don't forget there's a risk involved because not everybody's going to pay you, right? Sometimes it's malicious, and other times they just got bad luck, right? Because the older I get to realize, I realize luck governs your life more than I care to admit. No, seriously. Luck has more to do with your welfare than I would care to admit. I was kind of hoping it was my character, and I think it's more luck. Anyway, the point of the matter is, you got it. So there's a couple ways you can handle it. So in this case, let's start with the direct write-off method. So there's two ways, the direct write-off and the okay. So what we're going to do, we moved on to bad debt, and we're talking about bad debt, and there's two ways of handling it. Okay, so we're talking about accounting for bad debt. And one way is the direct write-off method. That's where we'll start. And another way is the allowance. So let's start with the direct write-off. So what's happened here is you've extended credit, and somebody now says, you get a letter that says, I've gone bankrupt. And you say, there's no chance of collecting this. So this guy named J. Kent declared bankruptcy. He owes you $520, and that's an accounts receivable. You're carrying your own accounts. So what you do with the direct write-off method, and let's say this is January 23rd, you debit bad debt expense for the $520, and you credit accounts receivable for the $520. So this guy went bankrupt, right? And so, and this is the direct write-off method. Now, then, of all things, on March 11th, he sends you the $520. Basically what he says is, I declared bankruptcy, but I'm reestablishing my credit. I'm not going to pay all my bills, but I will pay as many as I can. You're one of the lucky ones. Okay? So J. Kent sends you $520. So the first thing you do, this is a two-step process. So the name for this is the recovering of bad debt. And of course, what we did up here is we wrote it off. And now it's recovered. Now it's two steps. And step one is we reverse the write-off. And of course, what we're going to do is we're going to reestablish the account, which reestablishes the account. And then step two is we record payments. So again, this is a recovery of a bad debt. So in this case, the money was sent on March 11th. So what we're going to do is we're going to reverse the write-off. So we're going to debit accounts receivable for the 520, and we're going to credit bad debt expense for the 520. And then on the 11th, we're going to debit cash. So that was step one. We reversed the write-off. And of course, what we did is we reestablished the account. And without doing this, the next one wouldn't make any sense. Without step one, step two wouldn't make any sense. So then, on step two, we debit cash and we credit accounts receivable. So we need to do step one, because without step one, step two wouldn't make any sense. And step one reverses the write-off, which reestablishes the account, and then we record payment in step two. This is step one. And this is step two. Okay? All right. Now, you guys doing good? All right, you guys are doing good. Let's do some practice. Let's do quick, steady 9-9. I'll just write it up here. And you find that on page 381. Okay. So here's how it reads. So here's how it reads. So what it says is, the Krug Company determines on May 1st that it cannot collect $1,000 of its accounts receivable from its customer P. Carroll. Apply the direct write-off method to record this loss as of May 1st. So what you're going to do is you're going to debit bad debt expense, credit accounts receivable. You're writing off using the direct write-off method. Okay, it should look like this. So debit bad debt expense, credit accounts receivable, you're writing it off. Okay? And again, it's an expense, and you're taking it out of accounts receivable. Now, on 910, is everybody okay with that? Questions, committee guys? All right, so let's do the next one, 910. So it's a follow-up of 9-9. So on May 30th, Pete Carroll unexpectedly paid his account in full to Krug Company. Record Krug's entries to reflect this account. So don't forget, it's a two-step process. So step one is you want to reverse the write-off, which reestablishes the account. And then step two, you record the receipt of cash. So step one is you reverse the write-off. And then step two is you record the receipt of cash. Yeah,
Just a quick question. So if they paid in a different calendar year, would it be the same? Would it have to?
You hit on the nail on the head. That's why this is the dispreferred way of doing it, for that very reason. And it's the matching principle, we'll get into that in just a minute.
Okay.
But you're absolutely right, because that's exactly what often happens, and then that screws up the matching principle. And so, if you're okay holding off on a bit, we'll answer that in just a couple of minutes.
Yeah.
Okay. All right. So, you guys ready? So here's the two-step process. So step one is you reverse the write-off. Step two, you recorded the receipt of cash. Make sense? Yeah.
I don't know if it's really pertaining to this, but say you settle with someone, have you recorded a loss of what you settled for?
That would be a loss, it'd be a bad debt loss. So suppose what the guy says is, I haven't got the full 1,000, but I've got 700.
Sometimes we're in the hand
Oh, yeah, sure, and that can happen. Sure, that can happen. Then you'd have the bad debt expense of what you didn't get.
Okay.
And, it follows the same principles, just kind of an extra step. Okay. All right. You guys doing good? All right. So let's do this then. Now, Brian hit the nail on the head. The direct write-off method is FASB says, try not to use it. Now, the reason the problem is because don't forget, when you extended credit, you increased your sales. However, you expected some bad debt, and that bad debt expense increased sales. So you want the expense to fall in the same accounting period as the revenue, right? And what often happens is you have the sale in one accounting period, and then you have the direct write-off in the next accounting period, and the expense and the revenues in one, the expenses in the others. Now, sometimes the direct write-off method is the only one you can use, because there are some businesses who simply don't expect any bad debt. Like suppose they were a tractor salesman in a small town in the middle of nowhere. And they say, we've been doing business with these families for generations. When we sell a tractor, we don't expect bad debt. We have always been paid. If somebody doesn't pay us, we're honestly surprised. Well, the direct write-off method is the only way you can do on that. Second of all, the IRS only recognizes the direct write-off method. Because don't forget, it's on the cash basis, so it's when you incur the loss. It's when the cash is not sent. It's when you directly write it off. That's the IRS method. Okay? So sometimes it's the only one you can use because you can't anticipate any bad debt, and then for tax purposes you can only use the direct write-off method because it's on the cash basis. Okay? So then to kind of follow up on that, what you want to do now is you want to have the bad debt expense show up in the same accounting period as the sale, right? And that way you match the expense to the revenue. Okay, how do you do that? Well, you do that by estimating. So the second method we have is the allowance method. And so in effect, what you do is you take a look at your sales, take a look at your accounts receivable, and you say, I estimate that I will be unable to collect this amount. And that amount becomes an allowance at that time. Okay, that amount, I'll get that for you in a minute, Melanie. That allowance becomes the expense, and it shows up as an expense in the period when it occurred, right? In the period, same period as the sale. Does that make sense? Okay, so let's go into the allowance method. So what we have here then is, so it's the allowance method. And then again, now by the way, don't forget, materiality also feeds in here too, because if you use the direct write-off method and it's a small amount, it's okay to use it for that. So materiality comes in there too. All right. Now, let's kind of go up here. So the allowance method. So what happens in this thing? So let's have an example here. Okay. So the allowance method is what we'll deal with next. And what we do is we estimate the bad debt expense in the period of the sale. Okay? So in the period of the sale, we estimate the bad debt expense of the sale. And that way the expense shows up in the same period as the sale, and it's the matching principle. And again, there's two ways. You can do it based on sales. And of course, that favors the income statement, favors accuracy of income statement. Or it can be based on accounts receivable, which favors the accuracy of the balance sheet. And both are acceptable, okay? So let's start with based on sales. So what happens here now is, in this case, the credit sales are $300,000, and you estimate there'll be $20,000 of bad debt in those sales, okay? So you're saying the sales are $300,000. You take, at the end of the year, you take a look at that. This is an adjusting entry. You take a look at that and you say, when I take a look at my sales, I estimate there's $20,000 of uncollectible sales in these credit sales for this year. So, well, I'm sorry, there's $20,000 of, $20,000 of accounts receivable. I got you talking. And you estimate that $15,000 will be uncollectible. 1,500 uncollectible. Okay? So on December 31, it's an adjusting entry. You debit bad debt expense for the 1,500, and you credit an account called allowance for doubtful accounts, okay, for 1,500. Now, this allowance for doubtful accounts is a contra asset account, okay? So don't forget, what do contra accounts do? So contra accounts are valuation accounts. So the value of your accounts receivable is not $20,000. The value of your accounts receivable is $18,500. Okay? The net realizable value of your accounts receivable is not going to be $20,000. Rather, it's going to be $18,550. As near as you can figure, it'll be $18,500, because you estimate that you won't be able to collect $1,500 of that $20,000. How do you make the estimation, right? Well, often what you can do is you have a trade association that will let you know how things are doing. If you've been in business for any length of time, you can say it's a general rule, we don't collect X% of our sales, therefore we won't collect X% this year, and then often you adjust that for the economy. If the economy's roaring along, everybody's employed, then you lessen your bad debt. If the economy's really bad, you got a whole bunch of unemployment, you increase it, okay? So it's an estimate, and as such, it's going to be off. You base it, you make the best estimate as you can, and don't forget that estimate has to be defendable in an audit, okay? And your stockholders can demand to know why you found it, so it's got to be somehow defensible, okay? All right. Yeah.
What's the account that you credited?
Allowance for doubtful accounts.
Okay.
And it's a contra asset account. So here's what it looks like in a T account. Okay. So in a T account, it will look like this. So here you have accounts receivable. Here you have the allowance for doubtful accounts. And I'm going to abbreviate accounts, ACCT. And so now what you have is you have a $20,000 debit as of December 31, that's a balance. And here you will have a in December 31, you'll have a $1,500 credit in the allowance. If you take a look at the balance sheet, it looks like this. You'll have an asset section, and in the asset section, you'll have accounts receivable of $20,000. You'll have less allowance for doubtful accounts.
Can you do that, please?
Sure. Of 1,500. That will give you a net realizable value of 18,500. Okay. All right. So here's where you establish it. It's an adjusting entry. Okay. Now, how do you write it off? Okay. So I'm going to just mark this number 3. So if everybody's okay with that, well, here, I'll just put it over here if anybody's taking notes. And then I'll go on to the explanation. So what you've done now is you've just, you've allowed for the bad debt. And this step, this is like an insurance company. An insurance company can predict how many people will have an accident, but they don't know who, right? So you're estimating how much bad debt expense you can reasonably expect to have, but you don't know who. Had you known who, you wouldn't have sold it to them, right? Okay? So what happens when that person materializes? Okay? Then that's when you write it off. So here, what you're doing is, this is like an insurance company. They make an estimate as to how many accidents they'll have, but they don't know who. So you're estimating how much bad debt you'll have, but you don't know who. So then, you write it off. So the write-off looks like this. Make this number 4. And the reason I'll do that is when we have a review, I'll be able to put these up there. Okay? So this is the write-off. So when you write it off, in this case, oh, it's that damn J. Kent again. So J. Kent sends you a letter, says, I can't pay you the $520 that I owe you. Okay? So on January 23rd, you receive the letter. So now when you write it off, this is what we're doing now, right? You debit the allowance for doubtful accounts. Of $520, and you credit accounts receivable for $520. So this is the write-off, right? Now, let me show you one more thing, okay? So this will make sense. So now, if we go back to the, okay, let me just stop there. So now, notice what happens here. If we have, so what happens here is, here we have accounts receivable. And here we have before the write-off. Here we have after the write-off. Okay? And here we have the allowance for doubtful accounts. Okay? So before the write-off, the accounts receivable was $20,000, and the allowance was $1,500. Does that make sense? So this is before the write-off. And this is where it came from. So here's the accounts receivable, here's the allowance, okay? The net realizable value then is $18,500, okay? Now, with this write-off, the $520 came out of accounts receivable. That means that after the write-off, $19,480 is left. Then for the allowance, we took $520 out of it. So after the write-off, it's down to $980. And the net realizable value, this minus this, is $18,500. these two equal each other. So what happens on this thing is the net realizable value of your accounts receivable does not change after the write-off. And the reason it doesn't is because you're taking the same amount from both numbers, so the difference between them stays the same. And again, what happened is back here is when you declared the expense. Back here is when you have the expense and have the allowance. And so here's where you incurred the expense at the time of the estimation. Now when you actually write them off, you take them out of this estimation. Does that make sense? Okay?
Excuse me.
That sound good? All right. Now, you guys okay with that?
I'm still getting out of equals 85. 19,480 plus 980.
Minus 90.
Oh, minus, oh.
Mhm. Yeah, and so it's the net realizable is, yeah, the difference. Okay? All right. So, now, J Kent. So here's the write-off. Now, let's go on to the next step. What happens when you recover? Okay? Now, how many steps do you think there'll be? Say two.
Two.
All right, 2 steps. All right. What do you do in step 1? Reverse the write-off. Well, you reestablish the account. You reestablish the accounts receivable. And the way you do that is you reverse the write-off. Okay? And then step 2 is you record the receipt of cash. Okay? And they're the same 2 steps you did before, right? So now J Kent sends you the 520, right? J Kent said, we will go through this song and dance, all right? So what happens, again, it's in March 11th. So step 1 is you reverse the write-off. So you reestablish, and again, you do reverse the write-off. The object of the whole thing is to reestablish the account. The way you reestablish the account is to reverse the write-off, okay? Because step 2 won't make any sense unless you do step 1. All right, so you debit accounts receivable. So here was the write-off, it's over here, and we're going to reverse this write-off. Oh. Where did we do the write-off?
Right above.
All right, here's where we did the write-off. So we're going to reverse this write-off, okay? All right, so we're going to debit accounts receivable. And again, don't forget, you also have to update the subsidiary ledger. And we're going to reverse this, so it's 520. And we're going to credit the allowance for doubtful accounts. I'm going to do this over here because it'll put the page better. Okay? And then step 2, you record the receipt of cash. So you debit cash for the 520, and you credit accounts receivable for the 520. All right. So you guys doing good? Yeah. Okay. All right. So before we do some practice, let me have just kind of a summation here. So what we're doing now is we want to declare the expense in the same period that we made the sale. Okay? And to do that, we're going to do the allowance method. That was one so what we do is we estimate the bad debt expense in the period when it occurs. Okay? Best estimate we can make is an adjusting entry. And when we do that, both our income statement and our balance sheet will be more accurate. It's because we will declare the uncollectible accounts as an expense. That'll lessen our income statement will be updated. And then the allowance for uncollectible accounts, that's a balance sheet account, it's a contra asset, and our net realizable value will be as active as we can make. Okay? All right, and of course, so when we do that, we're writing off $1,500 here. That's our estimation. It's like an insurance company that predicts how many accidents will be. So you debit bad debt expense and you credit the allowance. Here's what it looks like in a T account. On the balance sheet, Then you have accounts receivable at 20,000 less allowance for doubtful accounts, give a net realizable of 18,500. It's as accurate as you can make it. When you write it off, what you do is you debit the allowance for doubtful accounts and you credit the accounts receivable. This does not change the net realizable value of your accounts receivable. And it's because here you incurred the expense and allowed for it, and now you're taking it out of that allowance. When you recover it, it's the same two-step process we did before. You reestablish the account by reversing the write-off, and then you record the receipt of cash. Does that sound good? All right, let's do this. Let's do quick study 9-2. Find that on page 380, 381. Okay, I'll put that up here. So here's 381. 9-2 is the very top. Okay. Put this up here. All right. So the Milner Corporation used the allowance method to account for uncollectibles. On October 31st, it wrote out $1,000 of account for customer C. Schwab on December 1st. And then it received $200 from Schwab. So prepare the entry to write it off. And they used the allowance method and then prepared the entry to reestablish it, to record the receipt of cash. Can I give you these right over here?
Yep.
Here's the plastic, here's the key. Honey, don't take any notes, just make sure I get everything back.
Mm-hmm.
All right. So I got Michael's back. Alicia, are you done with yours?
Yes.
Can I have this back? Thank you so much. Okay. Who needs a roll? All right. Good enough. Michael, I got your test. Here you are. You done- And everything look good, you guys? Look good? Okay. All right, thank you. So, everybody got the roll? Go ahead. Where everybody is. Are you done with that, Melanie?
No, I haven't, I was trying to do this.
Okay. All right. How's this for a set of answers? I can make that bigger. So they use the allowance method, so when you write it off, you debit. Why doesn't that focus? Should have put what was ahead of that thing, because it's doing good before. There we go. All right, so when you write it off, you debit the allowance for doubtful accounts to credit accounts receivable. Then when you receive the money, now in this case, they only received $200, so the first thing you do is reestablish the account by reversing the write-up for the amount of cash you received, and then you record the receipt of cash. That make sense? All right. You guys are doing good? All right. So, if you guys are doing good, we're at a perfect stop. Yeah, Andy?
Hi.